You're looking at a single headline about a failed loan, but what if I told you this isn't just a headline? What if it's a warning flare? One of the world's most powerful bankers, Jamie Dimon of JPMorgan Chase, just said the quiet part out loud about something called the cockroach theory of finance. The theory is simple and it's terrifying. When you see one cockroach in your kitchen, you don't celebrate catching it. You panic because you know with absolute certainty that for the one you see, there are hundreds, maybe thousands you can't see, hiding in the walls and breeding in the dark. Right now, that one cockroach is a series of seemingly isolated loan defaults happening in the fragile world of shadow banking. And the infestation it's pointing to is a systemic failure that could make the 2008 financial crisis look like a practice run. This is the story of how that's unfolding right now. It's the story of a hidden financial system, larger and more opaque than ever before, and how the first signs of its collapse are beginning to scatter into the light. During a recent analyst call, Jamie Dimon said something that made Wall Street sit up straight. After his bank, JPMorgan, took an unexpected $170 million loss on a loan to a subprime auto lender named Tricolor, he gave a stark warning. He said, I probably shouldn't say this, but when you see one cockroach, there's probably more. And so everyone should be forewarned on this one. This wasn't just an off the cuff remark. This was a deliberate signal from the top. He was telling anyone listening that the failure of Tricolor and the financial distress of another company, an auto parts supplier named First Brands, were not isolated incidents. They are symptoms. They are the first twitching antennae poking out from a much larger, much darker reality. And that reality is the $3 trillion private credit market, the beating, unregulated heart of the modern shadow banking system. This is a universe of finance that has exploded in size, operating outside the rules that were put in place to prevent another 2008. So, is Jamie Dimon's cockroach theory playing out in real time? The evidence suggests that the hidden risks simmering in the shadow banking system are now beginning to boil over, threatening a cascade of failures that our traditional banking system may not be prepared to handle. The next great crisis isn't just possible, it may already be in motion. To understand how we got here, we first need to explore the dark world where these cockroaches breed. To really get the threat here, you have to understand what shadow banking is. The name itself sounds sinister, and for good reason. It's not one single thing. It's a term for all the financial activities that look and feel like banking, but happen outside the tightly regulated traditional system. Think of the global financial system as a massive river. The main channel is the traditional banking system, your local Chase or Bank of America. This river has high, strong walls built from regulations. Banks have to hold a certain amount of cash in reserve. They have to report their activities to regulators like the Federal Reserve. They have deposit insurance to prevent bank runs and access to emergency loans if there's a panic. These rules, born from the ashes of 2008, are designed to keep the river from flooding the landscape. Now, imagine that thousands of other streams and murky tributaries have been carved out, all running parallel to that main river. This is the shadow banking system. It includes private credit funds, huge pools of capital that lend directly to businesses, often the very companies that regulated banks now deem too risky. Hedge funds, aggressive investment funds using complex, high wire strategies, often with a ton of borrowed money to chase massive returns. Money market funds, they look and feel like savings accounts, but they aren't. They're investment funds that buy short term debt. And in 2008, one of them breaking the buck helped trigger a massive panic. Securitization vehicles. These entities buy up loans, mortgages, car loans, credit card debt, bundle them into complex bonds, and sell them to investors. This was the exact mechanism at the heart of the 2008 collapse. So, why does this parallel river exist? It comes down to regulatory arbitrage. It's a fancy term for a simple idea. Money, like water, always flows down the path of least resistance. After 2008, the walls on the traditional banking river were built much higher. This made the banking system safer, but it also made lending more expensive and less profitable. The world's insatiable demand for credit and high returns didn't just vanish, it migrated. It flowed out of the regulated system and into the shadows where the rules were looser and the oversight was minimal. The sheer size of this shadow world is hard to wrap your head around. The Financial Stability Board, an international body that monitors the global financial system, says the non-bank financial intermediation (NBFI) sector now accounts for nearly half of all global financial assets. While not all of this is shadow banking in the riskiest sense, the part of it that does engage in risky credit activities has grown to over $70 trillion. The private credit market alone has ballooned to over $3 trillion. This is the fundamental danger. You have a system that performs all the risky functions of a bank but lacks the safety nets. It's a river without walls, and after a decade of calm, the water level is rising. As Jamie Dimon warned, the cockroaches are starting to emerge from the darkness. To see why a few troubled companies in 2025 could signal a meltdown, we have to rewind to 2008. Because at its core, the great financial crisis was a shadow banking crisis. Back then, the culprits were structured investment vehicles, or SIVs. Traditional banks used these off-the-book shadow entities to buy up risky subprime mortgages, package them into complex bonds, MBSs, and CDOs, and sell them to investors worldwide. The risk wasn't spread, it was just hidden in the shadows. The fatal flaw was a liquidity mismatch. These shadow banks were funding their purchases of long-term, hard-to-sell mortgages with short-term loans. When homeowners started defaulting, the value of the mortgage bonds plummeted. The lenders got scared and demanded their money back now. The system froze solid. This is when the crisis cascaded into the real banking system, taking down giants like Lehman Brothers and forcing a massive bailout of AIG. The lesson of 2008 is terrifyingly clear. A crisis that starts in the unregulated shadows does not stay there. It inevitably infects the regulated system because the two are secretly interconnected. Now, fast forward to today. The names have changed, but the game is the same. And we are seeing the first cockroaches. The recent bankruptcies of Tricolor and First Brands are perfect modern examples. Both firms were heavily backed by private credit funds. They were able to borrow billions more than a traditional bank would likely have lent them because the rules in the shadows are different. When they went under, the losses hit the private credit funds. But as JPMorgan's $170 million loss on Tricolor showed, the pain didn't stop there. JPMorgan wasn't just a direct lender. It was exposed through complex financing arrangements with the very private credit vehicles backing these troubled companies. This is the modern version of the 2008 connection. The big regulated banks act as the financial lifeline for the unregulated shadow lenders. In fact, Federal Reserve data shows bank lending to non-bank financial institutions has been surging, but the problem is even bigger. Around the time of Dimon's warning, two regional banks, Zions Bancorp and Western Alliance, shocked the market by announcing unexpected, significant losses tied to commercial loan fraud. Their stocks plunged. For investors, this was a terrifying sign that the credit rot wasn't just in the private world, but was already festering inside the traditional banking system. This is the cockroach theory in action. One failure, then another. A loss on a subprime auto lender, a bankruptcy at an auto parts supplier, a fraud disclosure at a regional bank. Individually, they seem like isolated problems, but together, they form a pattern. They are all pointing to the same epicenter, a systemic decay in lending standards and a mountain of bad debt hidden in the darkest corners of the financial system. Every time a new risk appears, defenders of the status quo say, "This isn't like 2008, we fixed it." But what if that confidence is misplaced? While the biggest banks are holding more capital, the risk hasn't vanished. It has metastasized. In many ways, the situation today is more perilous. First, size and opacity. The shadow banking system that fueled 2008 was a fraction of its current size. What's scarier than the size is the opacity. In 2008, the toxic assets were complex, but they were traded on public markets. You could see their prices collapse. Today, much of the risk is in private credit, bespoke loans made directly from a fund to a company. They aren't publicly traded. Their true value is whatever the fund manager claims it is. Jamie Dimon himself highlighted this danger, admitting that even he doesn't know the quality of the loans being underwritten in this massive parallel universe. Regulators at the Fed and the International Monetary Fund, IMF, openly warn that this lack of transparency is a primary threat to financial stability. Second, interconnectedness. The idea that the regulated banking system is safely walled off is a fantasy. The two are more intertwined than ever. The IMF recently warned that many banks in the US and Europe have deep exposures to non-banks. How? The big banks, constrained by regulation, enable the shadow banks by providing them with critical credit lines and leverage. This is the channel of contagion. The IMF ran a stress test to see what would happen if the non-bank sector got into trouble and drew down all its credit lines from the banks at once. The results were chilling. They found roughly 10% of US banks and a staggering 30% of European banks could see their capital levels plummet, potentially below regulatory minimums. A crisis in the shadow sector wouldn't just be a ripple, it would be a tsunami. And it's not just banks. Your pension fund and your insurance company are also deeply invested in this world, chasing higher returns in the riskiest corners of the market. Finally, and most terrifyingly, the liquidity mismatch. This is the classic setup for a financial panic. Shadow banks are borrowing short and lending long. They take money from investors who can often ask for it back on short notice and use it to make long term illiquid loans that can't be sold easily. This is the same vulnerability that brought down Lehman Brothers. When investors get spooked, they'll rush for the exits. But the fund doesn't have cash, it has illiquid loans. To raise cash, it's forced to sell assets at fire sale prices, sparking more fear and a death spiral. But here is the critical difference from 2008. A traditional bank has a backstop. It can get an emergency loan from the Federal Reserve. A private credit fund does not. When the run starts, there is nothing to stop it. We have a system that is larger and more opaque than its 2008 predecessor, built with the same fatal flaw, but this time with almost no safety net. The financial system is more complex than ever, and the official story often papers over the cracks. Understanding the powerful forces operating in the shadows is the first step to being prepared. If you want to cut through the noise and understand the hidden mechanics of money and power driving our world toward this precipice, make sure to subscribe and click the bell for notifications. The insights we share here are the ones you won't get from the nightly news. Staying informed is your best defense. So, why does any of this arcane financial stuff matter to you? It matters because a systemic failure of this magnitude would not be a contained Wall Street event. It would be a catastrophe for Main Street, potentially far more severe and difficult to solve than the 2008 crisis. First, a credit crunch. Credit, the lifeblood of the economy, would simply dry up. The private funds that have been fueling corporate America would vanish. Companies that rely on this funding to make payroll and invest would be cut off. This leads directly to mass layoffs. Second, the impact on your savings. Your pension fund and the insurance company holding your annuity are some of the biggest investors in the shadow banking system. They poured money into these funds, searching for returns. When these funds collapse, that money is gone. A shadow banking crisis could directly attack the retirement security for tens of millions of people who thought their money was safe. Third, contagion to the safe banking system. As the IMF stress test showed, a crisis in the shadow world would inflict massive losses on traditional banks. Suddenly, the mortgage you need to buy a house, the auto loan for a car, or the small business loan to expand your shop, all of that could disappear as banks stop lending to protect themselves. And finally, the scariest part, the government might not be able to stop it. In 2008, the Fed and Treasury had a clear, if controversial, playbook: bail out the big banks. But how do you bail out a system of thousands of unregulated, disconnected, and opaque private funds spread across the globe? Who do you give the money to? The tools used to fight the last fire may be completely useless against this one. The Fed can't be a lender of last resort to an entity that isn't even a bank. This is the horrifying endgame of the Cockroach Theory. It's not about one or two bankruptcies. It's about the realization that the entire foundation could be infested. The recent failures and fraud allegations are not the crisis itself. They are the warning. We started with a simple, chilling metaphor: the cockroach theory. One sign of distress points to a much larger infestation hiding in the dark. We've followed that trail into the multi-trillion-dollar shadow world of private credit, a universe created to bypass the rules put in place after the last meltdown. We've seen the echoes of 2008, not as a faint memory, but as a repeating pattern of opacity, leverage, and a fatal liquidity mismatch. We've heard the explicit warnings from the world's most powerful bankers and institutions like the IMF. The risk is no longer hypothetical. The tremors are already here. The financial system today is, in many ways, a ghost image of the one that failed in 2008. But it's bigger, more complex, and more deeply embedded in every corner of our economy. The regulated banks are just the visible tip of an iceberg of risk. This isn't about predicting the exact date of a crash. It's about recognizing the profound fragility of the system. It's about understanding that when the people who run the system start warning you about cockroaches, it's time to start looking for the infestation. The only question now is how big it has truly become.